Hello and good evening, everyone, and welcome to the Business of Property. I'm your host, Cheryl Leong. How are we doing today? I know all across Australia we've got various states of lockdown, so I hope you're all doing okay, which also means that you probably shouldn't have any excuse to not be here for this fantastic session today that we have with our special guest, Tony Lee from Lee and Lee Accountants. So, Tony is the founder and CEO of Lee and Lee Accountants. He helps property investors and developers really look at profiting, is that the right word? Um, Structuring their tax and their structures in the most effective manner, tax effective manner, to profit from their investments. Um, and has been doing so for the past 20 years. So he sort of knows what he's doing and has helped over thousands of clients. So I'd love to welcome to the Business of Property, Tony Lee. Come on down.
Oh, hello. Good evening, everyone. I am
Good.
so excited to see you all online
We are
and connecting
excited.
in to make a difference.
I know. I mean, I have to say, I had when people were responding to this session, and I love it when I can see who's and all of that. And there's so many people that were like, yes, I want to know, how can I structure my projects better, my tax better, so I'm saving on tax. I'm planning better for the long term with my projects and my own personal wealth. So, Tony, I mean, not only are you an accountant who specializes in property, you're a property developer as well. So you are talking the talk and walking the walk. So again, very excited to have you here today. But Tony, what are we going to be talking about today in today's sessions? Because I know you've prepared quite a bit for us to go through.
Yes, Cheryl, thanks again for the opportunity. Certainly, thanks for all the audience attending. Now, I'm going to make the best use of everybody's time tonight. Certainly, I'm going to share with you a bit of maybe just a sneaky preview or a killer strategy or structuring strategy. Uh, Pretty much if you follow and if you implement it, not only that you're going to have a greater flexibility, great ability to minimize tax, but you're also going to be able to protect your family home. Now, one thing for sure, your family is going to be very thankful about that you're doing it, and that you're also going to have a bit of a peace of mind from the ATO.
Mm. We like a bit of peace of mind from the ATO, but I think also what a lot of people feel when we're going into property, especially from a tax perspective, there's so much that we definitely don't know. And I think it's important that you have an accountant that not only understands property investment, but if it's you're talking about development and long term creating a development business or career and building your portfolio, you've got to look at it holistically. And it's
Mm.
when I say holistically, it's also not just the individual project, but it's your long term financial personal wealth growth as well.
That's right. Yeah, sure. Again, thanks so much for all the audience tuning in, whether you've been in Sydney and Melbourne. Certainly in Sydney, we're thinking of you. We're praying for you. No doubt you're probably waiting for the unlock. Come and visit us
Yes,
at the Goldie. We're definitely waiting
yes.
for you.
We're
Uh,
all moving up north.
Everyone in
Everyone's moving
pretty
up
much
north.
all around Australia. Certainly, I think, Cheryl, one thing that I'll share with you in terms of who is Lee and Lee and why we're here and what we talk about is certainly first and foremost, we are an accountant. So we're not your typical accountant. So certainly, please don't hold that against us. We are a property tax specialist accountant, business owner, as well as a SMSF specialist advisor here. So as an accountant, we really passionate about helping property investors, small business owner to build their wealth, but also protect their wealth. So what's happening is that over the last probably 20 plus years, I know I usually say to people I start when I was 10 years old. So I haven't got my gray hair around, but pretty much any prospective client that wants to kind of like join our firm, the very first things that we actually do is to do a free review, a complimentary review, where we provide you a second opinion, right? So that's the very first things that we do. No matter who you are, pretty much everyone that we see, we do a free complimentary review. But now, every client that we actually had an opportunity to do a free review in the last probably 10 years, overpay tax, or incorrectly structure their property investings or property trust structure. So most of them probably ended up paying too much tax, or probably shouldn't be paying the sort of tax that they'd be paying, or pretty much, like I said to you, incorrectly structured. So certainly tonight, we're going to walk you through how to probably from a personal life point of view, personal experience point of view, and also some of the real life example on how our clients are going through. I'm going to be sharing with you guys also just a really quick, maybe some of the win and some of the frustrations, and some definitely one loss. So audience can learn what happened if you made a bit of mistake. Certainly you want to get up and get going again, but learn from your mistake. So certainly I'm going to probably share with the audience tonight how to actually profit 6 figures income through property. We're using an advanced tax structure for most of the property investors and developer there, especially probably during the COVID-19 and beyond at the moment. Yeah.
Absolutely exciting here. I don't think anyone has been this excited about tax and accounting, but definitely when it says saving tax, I think you got everyone's eyes sparkling away. So, Tony, let's get stuck into it, because I know it's a really meaty topic. Here we go.
Yes. So certainly, I guess with the audience out there, probably just commenting in the comment, what are the things that you want to get out of session tonight? Certainly, if we got time towards the end, we'll take calls and Q&A towards the end. Okay. Yeah.
Amazing.
So probably one of the things that I guess I want to share with you in terms of property investors and property developers, some of the frustrations that I basically see probably in my experience being a property investors are probably just like you can see as I probably share along, they getting the wrong structures, maybe a little bit frustrated with so many structures out there, trust and company, and then SMSF. People get a little bit overwhelmed and kind of like really frustrated and confused. A lot of people kind of like basically hold back because it's either that they cannot get the right structure, or maybe just not getting the right advice that tailor to their specific circumstance or the current situation to what they want to get. So certainly I think, in terms of getting the right foundations and the right structure is critical. So a lot of the time, what I find, as I probably shared with you in the past, is that people attend a lot of different seminar, and generally they rush to the back, and there's a team of people out there pretty much supporting the sales, right? But often I find is that it doesn't really support what the client actually looking for and what they're trying to achieve. So certainly they are there to support you, the sales on the structure. So when this happen, what we kind of find is people coming in, they got multiple trust structure, company trust or super fund, but they're setting up in a way that's probably not beneficial to them, or in a wrong way that basically clients are overwhelming to a point that it's not really going to help them achieve their financial goal. So that's probably, maybe I'll share with you the common sort of problem that I face. People are trying to basically develop a particular property portfolio, but however, they probably find it a little bit more struggling, particularly when it's like coming to finance, joint ventures partner, putting deals together. Unfortunately, most of these struggles are, if you're not getting the right structure and the right foundations, you can probably stumbling into getting some difficulty with finance, and often allows you probably holding back or not able to continue to pretty much like build your property portfolio. And that's probably maybe I'll share with you tonight maybe 2 or 3 frustrations. This is the first one. Okay.
Yeah. That's a big that definitely is a big one. And I think, is there a for the majority of we'll talk about developers, is there just a one size fits all, or do you really need to sit down and say, what is the long-term goal, and what is do we then also have to have the conversation about your personal financial goals and your personal finance and assets and all of that as well, to be able to determine the right vehicle?
Absolutely, Cheryl. And this is why I'm saying, if you're buying under the property investings or development in the wrong entity or wrong structuring, taxation structure, often this will lead to either paying more tax than you should have been, or a structure that later on, if you're going to untangle or you're going to restructure, often actually cost you going to be more. So I'm going to share with you the situation, pretty much the question that you asked as well. But I want to share with you also the other second frustration that often people kind of pretty much my client see is that they actually don't know they may be putting not only the whole project at risk or even the family assets at risk, but also putting the actual profit in the project at risk as well. And often this becoming a reality if they also get the wrong structure, because some people don't really do the right sort of property due diligence or feasibility or analysis up front, jumping into buying the property, just getting whatever structures that I get from going to a seminar, and all of a sudden, you find that you set up maybe a wrong expectation, or particularly you might get the wrong taxation information, such as like never consider GST. We're going to talk on a little bit whether or not you're holding short term and long term, so that will affect your income tax situation, whether be it tax on a short term, being a revenue account, being in income tax pretty much from every dollar you make, or on a capital gain tax where you're holding it for long term, so therefore you might be eligible for a 50% capital gain discount if you're holding in an appropriate eligible structure. So certainly often people will lead to paying way too much tax as well, or often, as I said, probably costing a little bit more in later on if you do decide that you want to pretty much restructure. That's basically a bit of a frustration also, where you're thinking you're going to make a lot of money, but at the end of the day, you kind of feel like all the money that you're trying to make is actually ended up, going through the tax buckets. So
I'd like to ask anyone that's our audience. Sorry, Tony. I'd like to our audience, if you can leave a comment below, what sort of structures you've used, whether it's a unit trust, what are people use? So a company, what are some other ones that people might have used? I'd love to see you just get an idea of what different types of trust structures you have used previously as well. Someone has asked, kindly cover the costs as well.
Certainly, yeah, we'll go towards it, yeah.
Alrighty.
So another, as I say, one of the frustration is obviously not getting the right structure. Second sort of a frustration is most often people come across that we find potentially basically, not in control of what they do, right? Alternatively, just reach on profit. So not in control of what they do, technically just kind of like work around the area that they're not in control. It could be that because they are allowing other people or other advisor to set them up the structure the way they think is best for you without understanding your current and certain circumstances or future expectation, and certainly not getting the right advice up front. Certainly that will probably cost you a lot more down the track as well. As your circumstances change, your outcome kind of like maybe changes as well. So that's probably one of the first three kind of like frustrations that we see often coming through our practice. And so probably one of the fear is that the fear of maybe not making enough money at the end of the project, the returns are not as good what they want, maybe either paying a lot of tax because they didn't take into consideration so the margin scheme or the income tax, or whether it be tax on a revenue account or capital gain account. And so often, if you don't get that right up front or don't get the right advice, client often fear about getting an audited as well, okay? So that's probably maybe one of the three frustrations that we find. But what I find probably in terms of what do people really want, Cheryl? Probably if you see that, number one, first and foremost, people do really want to get the right tax advice, the right structure from the outset, get from the start, like having the right foundation, and then just bulking on top of it. I was going to share with you a little bit of those strategy. People I find also often they just really want to get the correct, like the certainty, having a right result, paying minimized tax legally, but also control and having that sort of security. So first thing that I see is that after working with so many different clients, especially probably in the areas of property investing and development, what we find is that clients truly really value what they want to achieve. But the first thing that really, I guess, came in my mind to share with you is that they often come across to me that they're really probably wanting to reduce the income tax that they're paying, and certainly, looking at maybe how to maximize the tax deductions as available for them. So working with a proactive specialist accountant that kind of like forward thinking for them in terms of having the proactive tax planning, like all through the year instead of pushing it through at the end of the year, where you're rushing to trying to get some tax planning because you went to seminar, you heard someone doing this and doing that, you're trying to bring it back to your accountant. And often the accountant say, well, you can't do that because your structure is not structured that way. So that's probably maybe one of the things that I see. Another one, just a really quick one, probably just by not having a proper property accounting systems in place, like bookkeeping, often, not working with a proactive specialist tax advisor, you find that you're not in a position to identify what is available for you in terms of tax deductible or even planning how to better minimize your tax. And critically, you also probably want to see a proactive advisor will help you to look for, that little tax deductions that you always talk about. What is the extra tax deduction? How can I claim it? So that a lot of clients are actually missing out some of the tax deductions that they're not actually claiming as well. So that's probably be some of the area that clients really want. So as I said, client really want to get the right advice, the right tax structure, but also just having the right certainty that they're getting the right structure and the right tax advice to make sure that when they pop out on the other end and lodge a tax return, they are essentially paying as whatever the tax that they expected to pay, and having a right structure, giving that peace of mind and the asset protection that they need. That's pretty much, I think. Well, what do you think? Like in terms of what do you think some of your audience maybe comment below? What do they really want out of being a property investor and developer? What I thought I'll share with you, Cheryl. I think you mentioned to me also to give the audience a bit of a sharing in terms of certainly a live example. And this is actually, I start with a challenging example on how a particular client kind of like come and visit us that actually made a bit of a mistake in terms of even just the structure, the strategy, the advice. So this is a case of individual kind of like basically structure it with the intention to buy and flip, build, subdivide 1 into 5, and sell it out to really, really quickly make a fast profit, like a quick profit. In a minute, towards the end, we're going to share with the audience in terms of if you are starting up, if you are in a maybe a scalable phase where your expertise and experience might be such as yourself, and say, if you're making the actual 6-figure, what are the things that you can learn from other people's, or particularly other client and investors actually made some mistake, and not to make the same mistake. This is a case that the individual client actually have a good structure from start. They have a very good intention. They want to buy, subdivide, and develop and make a profit and get out. The problem is that when situation change and circumstances changes, the challenge is that when you start sort of one partner want to do this, another partner want to do another way. Certainly, this mistake that we find is that if you're not sticking to the right strategy, and so all of a sudden the property take a lot longer to develop, you're changing strategy, you're buying and holding instead, you're claiming GST, now you got to get back. Suddenly, the property market change a bit, so all of a sudden there's a holding cost kicks in where the individuals are not considering. Certainly, we went from buying and developing and building and selling really quick for a quick profit into holding, because there was a capital that the property actually gone up in value in a very quick space of time. Suddenly change the strategy on holding, and guess what happened? 2-3 years later, the market changed, the property value plummeted, and now suddenly the rent plummeted, and all of a sudden you're looking at an individual carrying out a $370,000 in the last many years of carry forward losses. But if they do exit today, they also going to get copped nearly $500,000. So that's just telling you what not to do if you are changing strategy and not having the right structure for the sort of changes in circumstances. Yeah. I can't hear you. Cheryl.
I just realized I was muted. Sorry.
You're
So
muted.
really,
Yeah.
really important that we've got that strategy clear, as in whether we're building to sell or building to hold, because one of the key components of that is the GST side of things. And particularly if during the development you are claiming GST, and then you decide to hold, then there's obviously going to be implications from that point of view as well. So yeah, I guess this is an example of where things can go wrong from the beginning, well, along the way, if we're chopping and changing on a few things. So I know we've got lots of questions coming through here. Let's see what we can cover in your slides first, and then we might do a bit of a Q&A towards the end
Absolutely,
if we
yeah.
can't.
We'll cruise along fast, okay? Now, I've got another
Excellent.
example. I think you twist my arm last week, and certainly this is actually a fresh one. It's a newbie. It's part of our development project that's coming through. Definitely coming through next couple of weeks. So this is just another example. I would say probably not. Well, I hope that is a winning case for me. It's a winning opportunity. That's actually our own special little sweet deal. And you can see that we purchased that in Brisbane, 1.45. The quick strategy will be just buy and subdivide into 3 blocks. Strategy 1, obviously, if we can flip it out in the next 3-6 months, make a cool profit, and we get in and out, and we structure it in such a way that give us flexibility to just basically later on, I'll share with you how to manage my tax, how do I defer my tax, and how to basically pay whatever the tax that I deem to be appropriate, right? So that's something that we'll share with you in terms of getting the right strategy, having the right structures in place, getting the right tax, like you mentioned earlier on, GST claim, and making sure that we accounted for the margin scheme when we sell the property. And so that at the end, the net profit, I'll share with you how I actually manage and control and have the flexibility on controlling the profit that we have. Okay. So that's just one of them there as an example. Okay.
Excellent.
Now, I think I might have another one example. This is a really quick one. It's a winning case of another client of mine. That's a bit of a joint venture without getting into too much detail and giving too much away. But essentially, it's a client that actually found the property, joint venture with my client, who basically putting all the money partner as well as the funding partner. And the way that we done is that my client walk away a cool $500,000 profits in his own ownership structure, the entity structure, and then we manage the profit, how we pretty much
distribute
distribute the profit that way. So I'm going to basically share with you how we sort of control and manage that as well. Now, in terms of, I guess you're mentioning earlier on a little bit about, our approach, our structure. Most people, they come to investing in property, particularly in property development. The first and foremost, what they want is financially free, financial freedom. They want to make profit. They want to make income. Yeah. So we have actually put together a 3-step structure that I'll share with your audience today. It's a basically 3 structure sort of modeling that will help you to build your property portfolio, but also share with you the first pillar being, if you can see that, if you guys are really exciting about property, certainly I think you're in the right forum tonight. So property is a vehicle that we use to create wealth and to create that profit, the 6 figures profit we're talking about. Certainly our second pillar we're talking about is having the right structure and definitely getting the right tax advice. So what we're basically making sure is getting the right tax advice. What we basically meant is that most people also want to pay less tax, yeah, and investing in the right property portfolio that is actually grow. So if you see that, if you get the right tax advice and the right tax structure, you'll be able to have the ability to basically save more tax. If you have the right property, and certainly, make sure you do the right strategy, like property renovation, like our wonderful Belinda Smiths are doing, all the wonderful things they're teaching all her lovely client about buying and renovation. So we do a lot of and give a lot of amazing, beautiful structuring advice for her client as well, just purely buying and renovation. So stick to what you're good at doing and your expertise. Belinda is really good at that, right? You met her before, yeah? So if you think about like buying a subdivision, I done a bit of that as well. That could be another strategy you want to think about, doing a buying subdivide. Alternatively, if you're growing into like a bit of expertise, scale in a point that you're expanding, you're growing, you might want to do a bit of like a subdivision, be whatever subdivision, smaller scale or big scale. So one of the things that what we do when you talk about property is that you want to be able to think about, are you dealing with property renovation strategy, property subdividing strategy, or property development strategy? So when you're sort of looking at structure, there are different structure that is available for property investors for short-term holding and long-term holding. So you can looking at maybe a companies or a trust or an SMSF. We're going to touch on the advantages and disadvantages of using some of those structure correctly. The other thing that, you want to get basically a bit of a good tax advice. The opportunity of reducing taxes is there for everybody. So certainly our third pillar is about getting the right tax advice, because by getting the right tax advice, you'll be able to give you a lot more flexibility, control on the tax you want to pay now, you're going to pay tax you later, and also give you a bit of a planning opportunity, so that as your circumstances definitely change, the structure will adapt to those changes. So certainly with this unique model, what we see is that this is basically how we work with you to be able to basically help you to achieve the result every single year, right? To be able to achieve financially free and having that security pretty much that you're looking for your family as well. So one of the things that I suppose I go along pretty quickly, we mentioned a little bit about certainly, the investment time frame being a short term or a long term. So if you got a buying renovation, that could be a short term, right? So you need to understand the taxing point of buying a property renovations for a quick flip profit being a short term is taxed differently, as opposed to somebody might want to buy a property, renovate it, and keeping it long term. Are we together? You guys can
And
you hear me?
what are the key things to consider there? What are the key tax implications?
Well, absolutely, yeah. So if you are property investors, if you're a property developer, if you're going to do a short term, you're going to do a long term, you certainly need to think about, on a short term, you're probably buying a quick turnaround for quick flip profit. So certainly you need to think about anything with quick flip. You entering into a property development as a business with the intention carrying on as an enterprise with the intention and purpose to make a profit. So that will be taxed on what we so-called a revenue account, right? But if you buy a property and renovate it, and by the way, so if you do a short term, you do need to consider a GST, whether it's applicable to you or not, which, we probably have another session just on that, right? Because I can see a lot of people make a lot of common mistake as well with GST and margin scheme. Certainly, I think long term, you might get away from not worry about GST. And certainly the biggest point was capital gain tax, where long term could be taxing on a trust structure. You have 50% capital gain tax, as opposed to having in a company, you don't get capital gain tax exemption. But here's the beauty. I think you twist my arm again, where we're going to talk a little bit about having a buy and hold renovations long term in an SMSF, because taxing SMSF is totally different different taxing again, right? So we're going to touch on something really, really quick on that as well. The other thing I think I still want to quickly touch on is, the amazing concept. I think it's a little bit under, or maybe overly exaggerated in terms of control versus ownership. Yeah.
Yeah.
You probably often heard about that as well.
Yeah.
Yeah. So, control versus ownership. Control is like, I guess, human being, right? We're just an amazing species, right? We have the funny tendency that we want to own everything. We want to own our car, our house, and we want to own, our future retirement. But, I found out probably, from a viewer point of view, particularly tonight, if anything that you take away, I feel like this is probably the slide that I'll share with you in terms of takeaway. Now, I do have another wonderful slide that will impact you greatly, and also a big takeaway for our viewer and audience tonight. Certainly, I think in terms of this particular one, control versus ownership, is that control without ownership, it just really means carry no taxations or minimum taxation is really what it is, right? And so if you're willing to give up or at least relinquish the ownership while, like maintaining the control, right? You can pretty much, I dare to say, I get to see with my client, definitely with ourselves, to basically even have more wealth that you can actually control because of the significant portions of the tax that your income tax that you're not actually losing in taxes, right? Like capital gain that you can defer, particularly later on, you'll see that if you can actually defer capital gain in a pension phase through an SMSF, you're going to have an amazing, significant amount of minimum tax that you pay. What it means is you got a greater portions of income that you retain, right, for your future nesting, for your retirement nesting. So, if you paying a minimum or no tax at all, it just means that you have more money to live off for your retirement future. So, you can control, you can actually don't have to own everything, but you control everything. Does that make any sense at all?
Can you put that in a practical sense when you're talking about property and whether it's investing or development? What do you mean by control over ownership in a property sense?
Yes, absolutely. So maybe when I go through a proper structure,
Yeah.
in about maybe the next couple of slides, you can quickly see that as well. Pretty much, I
Okay.
demonstrate you how we can actually instead of ownership or control. Okay, yeah, makes
Okay.
sense.
Excellent.
Okay,
Excellent.
well, next one come along really quick. There you go. Choose your vehicle wisely. What does that mean, right? No, I think vehicle. One thing I was so amazed when I met a really great mentor, and I'll share this audience. I was just totally blown away, right? And this is more about choosing vehicle wisely. Like, are you choosing a company to do property development in and out, like a high rise, 50, 100 million, $200 million property,
Mm,
where you need to attract, big capital, what do you call, investors and syndicates and banker? Or do you want to put it into a family trust, a private trust, or a public trust? We call it like a registered trust at all. Alternatively, you want to put it into super or an SMSF. Now, in a minute, you'll see SMSF is basically self-managed super fund. It's just a structure. So choose your vehicle greatly. For example, one of the things that I took away with my mentor, in terms of differentiate, choose your vehicle rightly. For example, let's say you come to Brisbane, yeah. So remember, you promised me one day you and Belinda is going to come to Brisbane. Now here's the thing. Let's say I'm in the middle of doing an amazing renovation with Belinda as a partner, right? So I'm trying to impress her. So then she might be already in Brisbane, and then she might ring and say, "Hey Tony, could you come in and help me with this?" Now she didn't really explain to me what's going on and what sort of car I need to do. Now all of a sudden is that I go in with my dump truck, right? A dump truck, ugly dump truck, right? And now I rock up there. What she's saying is that, could you please go and pick up Cheryl at the airport because I'm running out of time. Now I'm going to rock up on a dump truck with a utility picking you up. Now you can probably appreciate not a very good presentation, yeah? and on top of that,
yeah.
not a very good fun. Now the thing is this, right? You can get A to B. You see what I'm saying? So is it the right vehicle? No, question mark. Now for you, obviously, instead, anyway, don't tell me what you're thinking, right? Because I know what you're thinking. Now, here's the thing, right? By the time you rock up, and you might call me again and say, Tony, now that I learned my lessons, Tony, can you please come and help me? Again, you didn't tell me what how do I show up and what do you need help? So I come in with an amazing sedan, yeah, or station wagon. And all you need to know, all I know is you saying, "Oh, Tony, it was running late. We got to put the property on market. We've done a little cleaning. By the way, we just need your help. I know you're an amazing accountant, but you keep telling me you want to help me. So please come and help me." And I rock up on a station wagon and say, "Can you please put all these dump that we have cleaned into your car so we can take it to the dump and chuck it out?" Now, is that the right vehicle? Probably not the right vehicle. So choosing the right company also makes a good sense. You know what I mean? For a carpenter, a company trust structure and SMSF to them, it's just a tool, right? For them to do what they got to do. For us as an accountant, we like the structure in terms of choosing the right vehicle. I mean, if you're doing a multi-big, national high-rise development, maybe a company is good enough because, again, as I said, you want to attract capital, right? Company in a minute, you want branding recognitions, you want to raise capital, and ultimately, the bank understands company, PTO Ltd, bank-like company. So do what the bank wants because what's important to me is the money. You know what I mean? Right? And then the company also greatly taxed at only about 25%. So it's not bad. Now, obviously, company has its negative as well. So trust is also good. In a minute, you'll see that the trust gives you flexibility and asset protection. And same as SMSF, you have certain flexibility as well. But at the same time, it's got an amazing tax concession as well. So certainly choosing the right vehicle is so important because I think what's happening is that if you choose the wrong vehicle, it will affect your taxation. It will definitely affect your flexibility and planning opportunity. So often this will basically lead to a humongous cost that you're not factoring in. And certainly you might end up having to transfer some kind of ownership back and forward to the rightful sort of individual, and suddenly you can see that it can be very, very complex. And certainly, buying the property or property investings and development, not considering short-term and long-term and the situation, circumstance, can probably cost you a lot of money. You can see the example, right? So probably first and foremost, I will always think that you need to basically know what is the purpose of your property, right? Like I should be asking Belinda, say, hey, what's the purpose of me showing up? Am I helping you taking your rubbish to the dump, or am I gonna pick up Cheryl at the airport? Yeah.
Yeah.
So that's probably maybe first and foremost. Maybe from a business point of view, I think that definitely first and foremost, I would think that you need to understand if your business model is to enter into a business arrangement with a partner or yourself for a profit and with the intention to make a quick profit, then certainly you need to think about maybe using a company or a trust for a short term that gives you flexibility and amazing control. But certainly if you're thinking about long term, like buy and hold, you certainly got to think about more, should I be putting in my name, being a principal place of resident to claim the main resident land tax exemptions and potentially a capital gain tax exemption, but without offering any asset protection. Remember I say, if you own everything, you don't control it, right? Yeah. So there's a risk associated with that. Certainly, I think if you are running a bit of a long-term strategy, you probably need to think about putting either in a company trust structure that gives you flexibility, particularly succession planning, but also, SMSF that will give you an amazing retirement planning. Potentially, you can defer the tax to the future, where you probably pay very little tax at all. So especially, I think being a company, you got to be careful as an investors or developers or property investors, where if you do particularly choose a company, you could probably have problem because you might have you take money out, you make a lot of money, you take money out, and certainly that money you take out, the accountant often that we see, suddenly the accountant give you this ugly look and say, well, I think you just trigger, or you're gonna have these challenges with what they so-called Division 7A issue, meaning direct loan account, right? Which could sometimes lead to a double taxation, right? You pay enough tax, but not enough. Yeah. So certainly, I think choosing the right vehicle, or you can see here as an example, the property structure option is so important. These are questions that I guess I get to answer your question where you're saying, well, what do you mean by control ownership? So here's a classic case about control versus ownership. Yeah. Should we go through this?
Let's go. Let's dive in.
Awesome. Okay. You get me excited. This is actually when I get started, that? Like, we're not
just
even
warming
started
up.
yet.
We're just warming up. That's it.
Yeah. Okay. So listen. I got a little bit more to cover. Should I go faster? Should I just slow down a little bit, or should we just keep doing the way we're doing? Tell me.
Well, I mean, I don't want to rush things too much, because I know that there are a few people that are asking questions around the benefits of company trusts and companies and trusts and the different structures. So let's spend a little bit of time around this, because I think if we need to be able to have another session, Tony, I'd rather do that. But I want to make sure that we're getting a good amount of value here without people going, oh my goodness, there's so much, but be able to take away from the session and then be able to add to it. So
awesome. Well,
I don't want you to feel rushed as well.
That's all right. Okay, so grab onto your seat, right? Get excited because there's a good one's coming up really quick now. So as I said, you property option structure is like you can buy property in an individual name, just like everybody can do, right? So you can always basically, normally what people do is buy property either in the individual name if they're starting it up, particularly if you want to buy the first investment property. They want negative gearing, they want land tax, they want minimal stamp duty, they might even want to buy family home. So therefore, they can live in it and then turn it into investment property later, maybe within 6 years, they sell it, pay no tax. They got all that amazing starting it up, low risk. They just want all that bells and whistles and sweetness out of what tax offer is available. And that's okay, because it's there as long as you do it with a right intention and a tax advice. Yeah. So you do that. Now, obviously, the other options that you got to look at is that if you suddenly become like me, or we deal with a lot of doctors as well, and physicians, and like dentists and all these specialists, they might become very risky individual, right? So like lawyers and other professional. So therefore, they might not want to have too many property in their name anymore, right? So that's like basically suggesting that normally you can buy property in your name. Certainly you can buy in a company. In a minute, you'll see that there are benefits in buying a company name. These are, by the way, individual, you can buy in a husband and wife, brother and sister, so two partnership, yeah? Certainly you can buy in a trust name, and as you probably rightfully point out earlier on in the beginning, you can buy in a hybrid trust, family trust, property investment trust, property development trust, or even a unit trust or fixed trust. Yeah. Now, the other thing is you can buy it in an amazing SMSF. SMSF, I put it in there. It's a structure. It's a tax structure, right? You get to control it. You create maybe up to 6 members, putting all the money in. You can basically, buy a property with an SMSF. So obviously, each of these ownership structure have its own distinctions of, like the advantages and disadvantages, the pros and cons. So, certainly I think really choosing the right ownership structure really depends on the circumstance of an individual and the objective the individual trying to pretty much achieve. Yeah. So the main thing, if you look at this here, here's a traffic light tax signal for you. There you go. Comment in as a viewer which traffic light color that you like, whether you want the green being 15%, you want 25% being going from 1st of July, any property development, subdivisions, as long as it's a profit with the intention to be taxed, certainly tax at 25%, yeah? Or you want to smack in the bum, I mean, can I say that on our audience? By the ITO, not by our spouse, you naughty boy, pay your tax 45%, you make 100,000, pay 45%, yeah? I always say that the ITO just bang you in the back, and just nasty take away that much money, right? So that's a traffic light signal. Now, to answer your question, this is the basic company structure. You can see that, right? So you could actually buy a property renovations or property development or property flipping in a company trust structure. Now, as you can see, companies are good because they're distinctively, it's a PTY Ltd, public limited by public, what they call limited liability, right? So protect the shareholder, right? Whereby the bank likes it because the bank understands it, right? By the way, there's like 1,000 trust structures, a million trust structures. I think it's including company, right? In a tax office, they're actually lodging tax return. So you can see that it's quite popular, right? So if you're going to buy in a company, probably the 3 best things that why people use company is that number one, maybe attract the funder or an investor. People understand. There's ownership structures of shareholder. There's ownership structures of control. Meaning, if you can see that, how to answer your questions. The sections on the right hand side where we talk about the holding company, holding trust, right? That's really basically a holding structure. That means you're actually in control, Cheryl, right? You have ownership structure like 10%, 100%. So technically, you don't own it, the trust owns it. So that's a classic case. We talk about control versus ownership. So you don't own it. So what it means is, maybe particularly for our greater audience, is that because I don't own the property, I don't own the share, I don't have to pay tax at my name because I just control it. So when I dispose on my property or I realize the profit will go back to the ownership, right, of the shareholder. Well, who is the shareholder? The family trust is a shareholder, not you. So that's really maybe a classic case about an example about control ownership. Yeah. So as I said, the benefit of having a company is threefold. Number one, remember I said to you with a traffic light, all right? You get to choose not to tax at a highest marginal tax, right? Now you get to tax at a 35%, 25%. I know everybody want to go towards a 15 and a big zero. Yeah. And I'm gonna get there. Just give me a bit of extra time, right? So if you're looking at this company, first and foremost, you'll be taxed at 25% on any profit. Now these are intentionally enter into enterprise with a profit view. So you'll be taxed at 25%. Be it you're doing a property renovation or you do a property splitting or subdivision. Yeah. Now, as I said, the second benefit is that the what we call the public recognitions or professionalism in terms of imaging and funding or financing it, right? Whereby the bank kind of like understand the vehicle. So certainly it's a lot easier to attract bank funding and investor funding. Yeah. So that's probably why we use company. As I said, remember, there is no right or wrong when it comes to structure. It really depends on your current circumstance and your ultimate outcome. The trick is getting the right advice from an expert advisor, understand the right structuring and understand listening probably is important, what the client outcomes are, what your ultimate objectives are, and getting the right structure to best sort of assist you to structure the ownership so that you can get the best outcome. Now, so that's just a company rolling along really quickly. This is a trust, the wonderful family trust, like a single family trust structure, right? We're not talking about having partnerships of trust with different family owner or investors model sort of type, like joint venture partner. So this is actually one of my probably earlier on deal where I buy subdivide into 2 or 3. So one was renovator. Second one, gosh, I wish that I actually met Belinda way early when I do that renovation. All right, so all the mistake that I made, crikey, you know what I mean? Certainly, the good thing is, I can walk her through it. Look at all the mistake I made. Look at the things that she was laughing at me. So, oh, you shouldn't do this. You shouldn't do that. Just like having a trust structure, right? Having a company doing a reno, and then suddenly you decide to hold it, you missed out the 50% capital gain tax. Are you following me? Yeah. So essentially, this is like buy and hold. It's actually a trust structure buy and subdivide. We call it SUD, single unit title, subdivided, and then we got a bit excited. We think we want to sell and make a chunky profit. Then we decided to keep it because obviously it's so good, right? So we put under a company trust structure. Now, you can see one of the benefit here, why we do company trust structure, this is a family trust structure or a property investment trust, is that first and foremost, I don't own the property, Cheryl. Do you see that? The corporate trustees actually legally own the property, and I control the property. I control the company that owns the property. Yeah?
Yeah, that makes sense.
Now, certainly I can only do this through company trust structure. So when I go home, I can do that with my wife. Now, she won't let me do the controlling bit, yeah? You probably do the same, yeah?
Yeah, that's
you
true.
you agree with me. Okay, so certainly, the benefit of having a trust is you get the control, meaning you own the share in the company, you are the director, you control, you tell the company director what to do because you're the director, right? You're the share owner. So you control the share that control the director and tell the directors what to do. Buy the company or buy the property, subdivide the property, keep it and sell it. So the trust gives you the amazing asset protection that we're talking about. Remember we're talking about, but one of the frustration is not having the certainty of security and asset protection. So trust gives you that. But again, you got to use it correctly, because what often that we see mistake also is that some people trying to save money, not getting a right advice, putting 2 or 3 property. I don't know how many times you see 5 or 10 property in a one structure in an earlier stage before land tax kicks in. You know what I mean? Certainly land tax is a deterrent now, but even if you have more than 2 or 3 property under one trust structure, it's not very smart structuring advice as well, right? Purely because you don't want multiple trust structure and you don't want to pay the extra accountancy fee or the ASIC fee to maintaining it. So that's probably the 3 benefit of the trust structure is first and foremost control. Now you understand control is way better than ownership, right? Because obviously ownership, you stand to lose the property if something does go wrong. Suddenly you become a big developer. In a minute you see that if you're in a level 4 or 5, you're going to become making a lot of money. That means you become a bit of a risky person, because you're taking a lot more risk. So number one priority in terms of the advantages of having a trust structure is definitely control, which we talk about. Definitely, the control with a trust structure, it comes with a bit of a benefit of tax, where you're able to defer your tax or control your tax. As I said, one of the things having the right structure, it allows you to basically control your taxes, have flexibility, and more planning opportunity. Yeah, are you with me?
Yep.
Awesome. Yeah. So look, as I said, there are things to consider. That the trust will come in a little bit more expensive. You basically have to pay, get a right advice to set it up, and there are extra costs to manage it as well. And obviously, trust sometimes one of the deterrents is that trust laws are changing all the time, and sometimes it could be very complex, and that's where you got us to give you the interpretation. Okay. So that's trust. Now we're rolling along really quick. Remember, I said to you another amazing structure to own the property is actually through an SMSF. Remember I said SMSF is just a structure, right? One of the benefit of that, you're in control, having a few members up to 6, probably not put, like ex-boyfriend and girlfriend together, get a little bit messy if you do put it in there, right? I know you can put extra there. Might be just, limited to husband and wife, might be, elder son, 18-year-old. You wouldn't do that, right? So don't do that to other people. Now, so if you put it in a company, a trust structure, as a super fund, certainly this is without the borrowing structure. And one of the benefits is that you can literally have up to 6 members now, pool all the money together and buy the property that you so wish to buy with cash. If you got $1 million in super, right, or $500,000, buy crypto, crazy crypto as much as anything. It's been around for 10 years, but it becomes so popular that everybody wants to invest in a unique direct assets. Now, super fund doesn't allow you to do that. So SMSF allows you that if I make a bit of profit, I contribute $27,500 into my super, tax at 15%. Now I get to actually buy the asset that I want. But here's the beauty, right? If the audience takes away, probably one of the biggest two benefit that I took away from all these 20 years experiences is, here's the thing, right? When you put money into your super, you get taxed 15%. 15% go to tax office. 85% get to reinvest. Right? Now, when you have your own self-managed super fund, you're in control, you got flexibility. When you put the, say, super contribution into super, you don't pay tax first. You pay tax at the end when you lodge your tax return, or when the accountant, the SMSF special accountant, told you how much tax you got to pay. What it means is you got that little windows opportunity to invest, yeah?
Yeah.
You understand?
Yep.
Obviously, the risk is you got to make sure you don't invest all of it, because you got to pay tax later. You know what I mean?
Yep.
So the three benefits you get to take away having an SMSF is definitely, if you're into property, you want to buy property with renovations and borrowing, SMSF is the way to go. But in a minute, I'll show you, you got to get the right structures if you particularly want to do borrowing structure. But if you don't do borrowing, it's an amazing strategy. You can buy property, considering, now this is again not an advice to everybody, right? This is just general understanding about education, is that, self-managed super fund is just a structure. You're in control. You can add up to 6 members. You can buy direct property, commercial, residential. You can do renovation if you want. You can buy whatever asset class you want that otherwise you might not be able to buy in a super fund. Now, the beauty is you can do borrowing. So this is what borrowing look like, right? There you go. See? Right? So, you have your self-managed super fund set up with a couple of members, up to 6, roll the money into it, right? And you can then, if you want to buy property, say $500,000, you want to buy $1 million property, you need to put in a proper holding structure to own that property and seek the bank to lend you the money. So that's what the structure look like. So the ultimate objective is, what you can achieve is that you're buying a future retirement home that ultimately tax at before 60 at about 10% in capital gain, or even better, 0. There you go, the big fat 0 that you're looking for, and a retirement phase over 60 when you're in a pension phase. How good is that? Is it good or bad?
And
Comment below.
Tony,
Yeah.
in terms, everyone wants to get to that point where there's zero tax. So step back a little bit with the self-managed super fund and then the six members, right? So we're talking about each of those members having a separate self-managed super fund going into a larger entity, or you're talking about individuals as members?
Yeah. So what happens, Cheryl, with this? So as I said, self-managed super fund, it's just a private structure that you manage. So you set up a company just like normal trust structure and trustees. Each member's got to be a shareholder and director, right? And each director and shareholder have to be a member. So again, previously you can have up to 4, but now you basically can have up to 6. So what happened is that you and your hubby set up a self-managed super fund just with 2 members at the moment, and so you roll in your superannuation from a retail super or public offer fund. So then if you got say 200-300 grand, your hubby's got 200-300, now suddenly you got 600,000 in a self-managed super fund. So that's what it is. So each individual member also control or also have their own member balance fund. So it's not like once it goes in, just because there's 2 person, each of you literally have 50-50.
Yeah,
so
that's
whatever the money
what I was
goes in
thinking.
is whatever your balance fund. Okay.
Yeah. Got it.
So that's the answer to your question. Now, the other one that I share with people often, this is becoming very popular, is that if you don't want to do borrowing, you can actually have, multiple self-managed super fund from different family get together using an amazing special unit trust to buy, the commercial property, such as like ourselves, if we want to rent our own commercial property back to ourselves. So that's you can do it with multiple family members as well. So this is the structure you're looking for, Cheryl. See? So if you do a property development in your name, right, you basically says, text me now. Now, how many people, comment below, you're going to text me now, right? See if any comments coming through. Text me a bit later. That's basically using a company trust structure. Yeah? And text me never. Who likes never text me? Or text me never. Comment below, please, right? So that's it there. Now, so see, this is what we talk about: tax me now, tax me later, or tax me never. This is like income distribution meta. So you know we're talking about if you are finally making the 6-figure profit, yeah. So if you're making a 6-figure profit, now you can basically, if you own it in your name, somebody said tax me never. Yeah, I love that as well, right? You can say, oh, tax me now, but obviously you want the money now, so you got to pay a tax accordingly to your personal tax rate. Tax me a bit later, it just means you can tax it in a company at 25%, and then when your personal situation changes over the year, you can then basically pay yourself dividend based on your tax structure, based on your tax circumstances individually, because then we can distribute dividend to you according whether you're in a low, obviously if you're in a low marginal tax rate, we tax you 20, 30,000, so you pay very little tax, right? Or tax never, you put money into super, you pay the 15%, the super money grows in value. As I said, you got more money to grow and reinvest at 85%, but that 85% keep growing for your future retirement. Ultimately, when you do retire in a pension phase, you never have to pay tax, right? That's the beauty of it, right? Legally, yeah. So this is how we show you. As I said, that's the structure that I've been operating for the last probably 20 years as well. We have separate. These are the amazing killer structuring strategy that I talked to you about. So we have a different business structure that run the business. We have property investment structures that that own control through us, but actually owned by the trustees company that control by us, be it in a for the benefit of my children or for the benefit of myself and my family. And this is a great office that we own. We have it in a different company trust structure, super, and you can see a couple of developments that we do. So if you make money out of there, see, this is what I'm talking about: tax me now, tax me later. See, you have an amazing opportunity to park the money into a bucket company, right? And that's where you say tax me a bit later and tax me a bit later. Yeah. So that's how we share with people how to use the amazing structuring strategy to help you to basically kind of like fit to your circumstance, your future circumstance, the result you want to achieve, rather than just go and get a cookie cutter off the shelf structure and say, yep, I need a piggy bank trust or something like that. Yeah. Now, maybe, just moving along forward, I'm probably going to stop a little bit, and we got a bit of maybe a few minutes, but what I'm trying to share with our audience is that, let's take a bit of a step back. You're pondering where you are now. We are bet, and from people like you guys in Melbourne and Sydney, you probably forget what date it is now. I always, my friend
Sunday.
told me, I have 11 meal today, and I don't even know it's a day or nighttime. How many meals I got, right? So, and then whenever I see a little car coming across, I don't care, it's a stranger, I just want to go for a car ride. I don't know.
The Uber driver. So everyone wants to jump into the Uber driver's car now.
I see the Uber driver bringing the food in. So, oh my God, I'm gonna go for a drive. I don't know. Just wait a bit now. So you might say this is 2021, right? August 24th. This is where you are. Well, ponder. What is your ideal future? Okay. Comment below, please. Right now, because the point is this, right? If you don't make a smart financial decision, you keep deferring it. You keep making mistakes. You keep putting head in the sand, right? And you keep drifting. You keep putting away. You keep procrastinating. Here's the problem, right? When you make a decision today, moving towards the green, the ideal goal and okay goal, you're actually moving towards a much more greater accelerated way with intention, with strategy, with the right structure, with the right tax advice, and with a great mentor and the right sort of intention. But if you're drifting away, you're delaying decision, you're not making smart financial decision, you're not getting the right structure, you're getting a lot more tax, suddenly you're pushing your way, slowly drifting away to maybe a situation that you don't want to be in. Yeah. So this is something that you got to make sure that I share with people, particularly with my client. Identify where you are now, what's your ideal future, where you want to be, how we're going to help you to get there. Yeah. So here's the final maybe acceleration, profit accelerator I share with you. So essentially what we probably look at is that normally when people come and see us, particularly client, there's 4 categories of people that work with me. So firstly, as I said, there's the people that might come to work with us in a starting phase, right? Level 1, for example, right? And then in which case, you're leading to level 2, which is pretty much like a growth phase. And level 3, you probably be saying, yep, I'm a little bit more expertise now. I'm going a little bit expansion. And lastly, I'm going to get into scalability because I got more leverage, I've got more experience, got more skill. I've been to a lot of seminar, I've been to more, I got more like context of joint ventures, and I know a lot more funding opportunity. So what normally people do work is that they're starting up in an initial phase, a starting phase. So they might start with zero, right? Probably might take them between, if they've been to a seminar, they've been to some training, they've been to some learning, they got great mentor, they probably take 6 or 12 months, maybe a couple of years to make their first off the mark from 0 to 50K. Yeah. But if you become a little bit expert, intermediate, and become really, really good at what you do, maybe take you 3-5 years or even 10 years to get to level 2, level 3, level 4. So here's the thing, right? This is a sort of money that you'll be making. In level 1, you probably be making, you still got full-time job, you just want to dabble into a bit of property, you've been to some seminar, you got some coaching, you know what I mean? And so you're probably making 50 grand, right? Here's the thing, right? Ultimately, what you want to do is to focus, and again, please comment below, our viewer and our audience, right? What sort of level you want to be? Level 1, level 2, level 3, or level 4, yeah? So normally people started up in, as I said, level 1. They might cruise on to level 2, do a bit of rental, flipping, and selling it off, right? But here's the problem, right? Normally they go into the expansion phase. They start looking at leveraging, right? They start to looking at scalability, doing partnerships and bigger chunk deal and joint venture. So they start looking for maybe anything more than 100, 200, or even 200 grand plus deal, right? So what people really are at that level 4, is that they already got an amazing focus of at least a specific strategy that they will find, or at least they got the right strategy and the right team, the right focus, right? The right connections, the right people, the right systems and processes, right? So what you want to do is that, thinking about, if you're starting initially, you want to be really, really good at what you do before you move on to the next one, when you start making, like, focusing on cash deal, good equity booster, maybe starting up with really good simple strategy with quick flip, for example, yeah? And then when you get really, really good, where you do quite a few of it, you become really good at what you do, then you start dabbling into maybe level 2, renovate a deal, buy and hold, or buy and flip chunk deal, right? So what happened is that when you really get familiar, where you're cruising along, level 3 and 4, you basically doing a lot more deal, either in splitter block or subdivision block, and you're in a basically scalability phase, right? So this is where you got, as I said, you got more experience, more contact, more knowledge, more people skill, and so you start generating chunky profit, or you start thinking about, maybe how do I shift towards buy and hold strategy, so then I don't actually probably do too many deal now, and then I can just maybe retire or maybe slow down a little bit and rely on the passive income, where the property is now generating rental income below, right? So maybe with a viewer, please comment below, which level are you guys in? Be it level 1, level 2, and level 3, level 4. I know some people say, what about level 5? Well, next seminar, let's do a level 5. So please comment below, what level you're in, and let me know, okay?
Excellent.
Okay, now I think we probably got a few more left. What I was gonna say is, what strategy is your viewer actually currently doing? So share with us what kind of strategy you currently do. Certainly, moving from there, where we go from here. Pretty much what we want to do is that, if you are pretty much a property investor, property developer, there's 3 ways that we can help you as well. Get very, very clear about the strategy to make a profit, and get the right property development structures and tax advice, and surround yourself with the right smart advisor that will help you and give you a smart financial decision, so that, as I said, your family can be thankful of you, and don't have to worry about an audit from an ATO. And if they do, you'd be ready for it. So that's pretty much, I guess, my a bit of next step here is basically, just make a call. We can do a bit of a 15-minute sort of review session, just looking at what strategy you're doing. Why do you want to use that strategy? What's the right structure? Is it a short-term structure, a long-term structure? Have you got the right tax advice with your feasibility and your due diligence, right? And ultimately, if you're looking for a second opinion, if you're looking for having an opinion whether or not your structure is actually right for you, certainly, yeah, give us a ring and schedule a call. There'll be a link later on that you can sort of choose to schedule a call for a 15-minute, maybe a quick sort of chat, so that we can maybe steer you in the right directions.
Awesome, awesome, Tony. And I notice it is just after 9 o'clock. But if anyone wants to hang around, Tony, do you have another maybe 20 minutes or so? Because we've got a few questions here, and I
Yeah,
know
yeah.
we went through quite a bit here. Shall
Mm.
we pick some of these questions on, if you can see them on the right side of the screen, Tony? Can you see them? Our comments
Yeah. Do you want to
to
read
the
out the
right of the
comment?
screen. So
Mm.
there's one. If you want to stay around to listen to some of the answers of the questions in the comments, please stick around. We probably will keep it to the next 20 minutes, so the rest, everyone can get a bit of an early night. Let's kick it off. Kindly cover the margin scheme. What is the margin scheme, Tony, and how do we calculate it, particularly when we're doing feasibilities?
Yeah, absolutely. Now, I'm assuming a viewer and audience question would be, I'm doing a property renovation, or I'm doing a property subdivision or a split up block sort of thing, where I'm buying a property, which is like an input tax apply from normal mom and dad. So that's what we
Mm,
call no GST. So you don't claim GST. So you have what we call a cost base, being say 500 grand that you buy a property. Now, and
yeah.
then you subdivide it into two blocks. You then build two houses on it, call it like $1 million. So that million
Yes.
bucks you would have claimed GST on the $1 million on the bill, right?
Yes.
So the margin scheme just means it's helping you to, if you use it correctly and make sure you get the right advice, and make sure when you do sell the property through the contract, get the legal advice about making sure that you explain to the buyer and sellers that agreed on the margin scheme, where if you do sell it for, let's say, $2 million, so $2 million, what you do is the $2 million minus the cost base, which is the land value that you purchase, which is $500,000. Okay, so 2 million minus $500,000, that will give you $1.5 million is the GST payable, right?
Mm,
Whereas if you were to sell the property at $2 million, you would pay 2 million of 1/10 of that. That's a lot more GST to pay, as opposed to GST payable using the correct margin scheme,
yeah.
where you now reduce from 2 million to 1.5 million, purely because the margin scheme is the cost base of the actual land value that you pay earlier on. That will
Yeah.
help you to reduce your GST payable.
So it's
Does that make sense?
important when you're purchasing to be clear as to whether, when you're buying, whether that includes or excludes GST, correct?
Well, usually if you buy from like mom and dad, you don't have to worry about
Yes.
that, because that's an input
Correct.
tax apply and there's usually no GST, right?
Yeah.
But it's only when you do sell a property, if you're a developer, as I said, I'm
Mm,
assuming the viewer is a developer,
yes.
um, and not buying whole. As I say, if you're
Yes.
buying whole for long term, you cannot claim GST, therefore margin scheme doesn't apply to you. Yeah.
Hmm. Okay.
Okay.
Excellent. Next one. Okie dokie. Okay, unit trust. We talked a little bit about the pros and cons of different trust structures. If you can touch very lightly on the costs of setting these structures up and ongoing costs.
Yeah, absolutely. Thanks for the questions. Look, it really depends. So I'm not sure you're talking about the a family trust, like a family trust, single family trust, or a unit trust with multiple family unit holder. Generally, you want, when you do set it up, you want the bank particularly wants to have a dedicated new trustees company as trustees for the trust. So I've been talking about maybe a family trust or a property
Mm,
investment trust, which is a discretionary with one single family. So the setup cost on that, again, everybody's different, so it varies. So certainly, the cost could be anything from $1,500 to $2,500, including either the company and the trust outlay, as well as plus or minus advice. It really depends your situation. Like, how much advice do you need? How much do you need strategy? Do you need a proper advice going through, or do you just, as I said, get a basic advice, which we don't advise. We don't give advice on that. Or alternatively, just get a full advice, and making sure that we assist you and guide you all the way through from A to Z. Now, in terms of maintenance, generally you got to pay for the ASIC fee,
mm,
which is the annual company statement fee, that regulatory requirement that you got to pay, probably roughly about maybe just under $300, 276 or something. Bit of maintenance fee, and then you got your average sort of if you are keeping the accounting fee, you probably get a zero or some kind to set it up. Anything range from maybe 15, $20 with or without GST to subscribe the GST. The zero. And obviously, I'm assuming that you might be, confident enough to do your own bookkeeping. So it's a case of maybe the accountant do your review, make sure the GST correctly recorded and claimed, and lodge the best for you. And at the end of the year, if you do a property development, kind of like finish in one financial year, again,
Mm.
it just very better. You got a small project or a big project, yeah.
Yeah. Yeah, 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 absolutely. So, I mean, but it's not, you're not talking about tens of thousands of dollars to be able to
Not
save.
really. No, I mean, look, like if you're looking at like the way that I've done 1 into 3 is a very, very quick. I don't even build. I basically do 1 into 3 DIBA, hopefully all at the same time like because I started up in July. So basically now it's August. So let's say if I do be lucky, I sell it before 30th of June. So that's one cycle, one financial year. If I'm
Mm,
lucky, I get it in, I pay a bit of ASIC, I pay obviously the structure setup, the zero setup. Obviously I do bookkeeping, the accounting. Look, you want you'll be looking at budget between maybe 2.5 to 3-4 grand. If you depending on like whether you need tax planning advice or tax advice along the line, like early on we talk about you need a specific GST or margin scheme advice. I mean, but
yeah.
generally, yeah, if a one cycle property sort of what do you call financial year, you'll be looking at on a smaller project, probably, you'll be looking at probably between 2.5, $3,500. Again, it just depends on what other services that you need as well.
Mm, excellent. So this is an interesting one. Sure. Can you read that at the bottom, Tony?
Oh
Can
yeah,
you
yeah.
attach your enterprise to a religious entity and not pay any taxes like a church? I don't know if you get in trouble
Yeah.
responding
Look, I mean,
responding to this,
very,
Tony.
yeah. So the viewer asking the question, pretty interesting. I mean, certainly, I think I can take it offline to have a little bit more in-depth,
Yeah.
personal, private discussion. But certainly, I like about like my trust, for example, and a lot of my client trusts. So what happened is that we might decide that 10% of our profit we're going to be donated to a particular charity cause. So
Mm,
we designate in the trust structure. Once we make the profit, before we distribute all the profit out
mm,
to our family member and bucket company and related trust structure to use up all the benefits of like losses and other sort of a distribution. Or I would probably distribute. You definitely again depending on individual circumstance, the way you set up it all. And as I said to earlier on, trust gives you much more flexibility, so you can build
mm,
in that distribution to the registered sort of religious organizations or particular distribution beneficiary that you wish. You know what I mean?
mm,
Certainly, you got to
mhm.
be careful not overseas, so then you'll be taking a marginal tax rate as well. Yeah.
Yeah, yeah. Okay, that's a interesting point. And say if you do you have to establish the beneficiaries from the very beginning, as to
Yeah,
say
so
if you
so
want to
just be
put
very
10.
careful. That's why we're really busy. Often clients say, "Why are you so busy at 30th of June?" Right? So yeah, we've got a nasty habit leaving everything to the last minute too. We're
Yeah,
just a simple human
absolutely.
being, right? Just with a bit of what do you call it? Differences there, right? So the main thing is that certainly before 30th of June, there's a tax ruling or the tax law suggesting that you definitely want to make your they call it a trust resolution before 30th of June, so that the ATO pretty much expected that just before 30th of June, you would need to know how much estimate profit you're making and who you want to distribute it to.
Okay.
So that's
All
the
right.
time that you
Good,
need to consider. Yeah.
good stuff. Excellent. All right. Next one. This is another interesting one. So really, we're talking about changing of structure and ownership. Um, For the first home buyers grant, how long do you have to wait until you can change the property structure from individual to another structure? This comes down to ownership, correct, Tony?
Yeah, so very good question. Look, I don't want to give any advice on that. I mean, look, you can probably go into the government website, check it all out. Certainly, when you buy the property and a first owner, you're probably going to get government grant. You probably get very minimal stamp duty. I mean, first of all, I'm thinking, why would you want to transfer to another structure in the first place? What are the benefit? What you're trying to achieve? What's the ultimate objective, right? Then considering the pros and cons, certainly because you're buying as a first owner grant, and you need to make sure that you satisfy those regulatory requirement, those criteria, in order for you to kind of like switching over. But remember, I said to you earlier on in our earlier sharing, any time when you kind of think about restructuring, change of circumstances for the reason of maybe asset protection or converting PPOR into an investment property, or maybe
Mm,
converting PPOR into development property, you just got to be very careful, because there is property with the basic nature of property. There's a huge amount of sort of a cost coming in, and certainly there's a huge amount of cost going out in terms of restructuring. So certainly I will sort of think about first, why do you want to do it in the first place, as opposed to, certainly in terms of answering your question, how long it's going to do. Look, I mean, you have a look at the government sort of website. It does tell you how long you need to stay there before you sort of becoming eligible for
mm.
those government grant.
Yeah, and I believe so that you need to be purchasing the property under a personal name.
Absolutely, yeah. It's got
Needs
to
to
be in
be,
personal
yes.
name in order to get the exemptions. That's
That,
right. Yeah.
yeah, absolutely. And I think that's the end of the questions, Tony.
Wow. Awesome.
And I'm
Okay.
sure there might be more out in Facebook land or LinkedIn land. But I want to say a very huge thank you. That was extremely valuable. Thank you everyone for listening. Your questions. I'm sure that if you've got other particular questions, I think in summary, what we were saying is that there is no one size fits all. Unfortunately, there isn't. We wish there was a magic pill, but it really will come down to your individual circumstance, what you're trying to achieve long term, and what stage you are in your life as well, I guess, as to what type of structure would be best for you. I really like that you're looking at things from a holistic point of view. I haven't, not many accountants that I've come across that will say, okay, what do you want to do from a, using property as a vehicle to be able to then manage your tax and your long-term personal wealth. You're looking at that holistically, and then looking. I really like how you've got that first level of structure, and then you've got another level of structuring as well to be able to get to that point where you're tax me never or very, 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 very little. So
Absolutely.
fantastic.
Absolutely.
And so if you want to be able to reach out to Tony to see if you may be doing things a lot better, more tax effective, here are Tony's details: leeandlee.com.au, Tony at leeandlee.com.au. He's obviously got all his socials down there as well. Reach out to Tony. He is definitely the chattiest accountant I've ever come across, but also probably one of the most knowledgeable in the property investing and development space when it comes to accounting and tax structuring. Thank you. You
Awesome.
deserve
Awesome.
a big drink for that, Tony. Thank you for putting those
Yep. I
slides
got
together.
I got one waiting for us. All right. Thank you so
Amazing,
much. Thanks to the viewer
amazing,
and audience. Wish you all
amazing.
wonderful success and all the best. And we'll look forward and catch up again. Thanks, Cheryl. Thanks, everybody.
Excellent. Thanks, Tony. Thank you so much. I hope you all enjoyed this episode of the Business of Property. If you want to watch any of our previous episodes, hop onto our YouTube channel and keep safe, everyone. Keep well. Keep sane. Also, good luck with all your projects as well. Love for you to share. And we'll see you next week on the Business of Property. Take care. Bye bye.